Okay, hello, welcome to the second day of our basic training. So, in the previous class, we talked about market structure, supply and demand zone, supply become demand, demand becomes supply, and we also stated that the demand becomes supply zone is also, we can also refer to it as our breaker, right? This zone, this supply zone that got disrespected, that caused the break of structure, is also known as our demand supply zone, or we can also say it's a breaker. And we also expect price to make a reaction at that breaker. You understand? That zone is also an important zone. So we talked about these things on the last video. If you've not watched the video, I'll leave a link below the description of this one for you to watch. That video is very insightful video. So today we are going to be talking about range, market range. um we are going to talk about market range, what is it called, and market range, entry points, um uh, discount zone, and what again, and engulfing candle, so now, what is a range of a market? A range of a market is the point, the low that broke a high, and this very low here that caused the break of the structure, this very low here that caused this break of the structure, and this high where market starts to drop down to this way. This high becomes the high, and this low become the low. So that point, those 2 points, is known as the range of the market. So the range of the market is now this low. I'll indicate it by red so that you see it properly. This low and this high, that is our range, and it is expected for us as traders to trade inside this range. If anytime we want to take our trade, we'll be looking for trade inside the range, inside this high, inside this low. And how do we, what's the proper way to get a range of a market is to use the higher time frame. We cannot be using 15 minutes or 30 minutes to determine the range of a market, because we might also get it wrong. So for you to properly determine the range of a market, you must use higher time frame. Me, I prefer the 4 hours, the 2 hours, or even the 3 hours time frame, depending on the time frame that shows clear break of structure and clear candle formation. That is the time frame that you are going to use. So I will use this diagram to explain the range which I've just explained, and I'm also going to explain the what's it called, the 50 the discount zone, and also the entry point. But there are things that I did not mention in the last class, and I think those things too are still relevant, but still, to me, I feel it's not that relevant, because what we just need to know is how to come to the market and make money and go out of the market, right? Things like Asian session, because we have three types of sessions. We have the Asian session, we have the London session, we have the New York session. These are the three major sessions. We also have Frankfurt session and one other session like that, but those sessions are not that major. So these three ones I just mentioned, Asia, London, and New York sessions, are the major sessions of the financial market. You understand? And there's also what is called accumulation, manipulation, and distribution. You understand? Those are also the market phase. Accumulation phase is when market would not do anything, would just be ranging up, down, up, down. Then manipulation is when either price will now manipulate that high, this high here. So this is the manipulation, manipulation. And when we have our manipulation, we now have our distribution, demand zone, and distribute, right? So that is how market. So the three phases: this one, ranging market, manipulation market that break the ranging zone, then distribution, where we take the order. That distribution is the continuation of the manipulation phase. So if price manipulates to the upside, price tends to distribute to that upside after getting order from the demand zone at that point. So that is the three phase also of market movement. So we are going to be talking about manipulation, distribution phase, as we talk about entries in our what, in our discount zone. Now, what is a discount zone? A discount zone, the way we're taught, is said to be the 50% of the high and the low, right? That's the normal way we're taught. But now, if I want to get my discount zone on the normal way, I would say 50% of this zone of your range. Then 50% is this. You see these dotted lines here. See these dotted lines. This is the 50% zone where it's supposed to be our discount level. So we are going to mark that place as our discount level and just align the candles like this and wait for market to come and react at that place. So but with time, I have discovered that the discount zone is no longer that place, but the discount zone is now the 50% of when the market broke structure. So at that point where market breaks the structure here, this zone here, this high here, and this low. So discount zone is the midpoint between this high and this low, where market breaks structure, right? So now let's get our discount zone now. So for we to get our discount zone, we just find the 50%. We can use the this box here to get the 50%, or we can use a what's it called, Fibonacci. I've forgotten the name. I know it's Fibonacci. Let me check for it. It's just I don't use those same tools because I just use the one that is easier for me. Okay, Fibonacci retracement. You can use the Fibonacci retracement to this one here, right? You can use it to get your 50%, or you can use also the box to get your 50%. So once you mark your 50% zone, you label it as the discount zone where you are expecting price to retrace to. It's a very simple concept. It's a very, very simple concept I'm going to show you. So this is the 50% of the zone. Now remember, this zone is on only the higher time frame. You are marking this. Nothing concerns you with the lower time frame or break of structure. So after this class, I'll put everything together and you see how to start from the higher time frame, lower time frame, and get your entry, and how you are going to be profitable also. So we mark this as the discount price, and we can either we bring down the box here to mark the zone, or we just delete it. We don't really need it because we've gotten the discount level, which is the 50% level. We've gotten our range, the range high, the range low. And one thing we can also do is to mark the demand zone. So let's just mark the demand zone and keep it. But mind you, market may not come down to that demand zone. Market can just give a reaction inside this 50%, this 50% zone here. Inside this 50%, market can just give you a reaction inside there. And when we get the reaction from here, from this zone here, or from the demand zone, then we buy up. You understand? We buy up. And what is the reaction that we are looking for us to take the trade? At this point now, when market start retracing down, when market start retracing down, there is a reaction we are looking for after market gets to this 50%. Market will break that 50% discount zone. Mind you, a discount zone is just a zone where price is offered very cheap. You understand? You cannot be buying this market because has already broken structure. We know that market is now bullish, but then we cannot just buy price. We cannot just enter the market at any position here. That's why we set our discount zone where price can be offered to us at a very cheap price so that we can enter the market and make much profit. If we enter the market at the premium level at the top here, market might sweep us and we take our SL. Or even if we become successful and the market goes up, we might not make much money than when we allow the market to come down here, tap our discount zone, then we buy up here. You see, the distance between the discount zone and the premium zone would give us a lot of profit. So, like I said, there's a reaction we are waiting for. We want to see at this discount level for us to be able to take our trade. What is that reaction? We are looking for price to come down. Okay, let me just use, as price is coming down, from that um, range high. Once price is coming down like that, let me okay. So once price is coming down from that range high, what you just be seeing is higher high, higher low, higher high. I mean, lower high, lower low, lower high, lower low, lower high, right? Lower high, then lower low. Price will now sweep. Price will sweep the lower low, just as we've seen here. Price will now sweep the lower low here. So price will sweep here, cause a break of structure, and now manipulate. Now remember, all these things we should be looking at this thing inside the discount level, inside this zone, inside this place that I marked. Inside this zone that I marked, that's where we should be looking at that break and sweep manipulation. Then we buy up, right? Inside that discount zone, that's where we are supposed to see this setup. If we see this setup inside the discount zone, we buy. If we see anywhere we see manipulation, we buy and make our profit, right? Anywhere we see manipulation, we buy and make our profit. So once price gives us manipulation, what is manipulation? What is manipulation? Manipulation simply is, remember I told you guys that when price is breaking lower high, lower low, lower high, lower low, lower high, lower low, lower high. Now price is not supposed to take out this high, right? Because price has been respecting the supply zones coming down, creating a bearish structure coming down. Price is supposed to respect the supply zone, but when price breaks the supply zone up, it is now called a manipulation. That means a manipulation has occurred. That is what I call manipulation, because price has now manipulated the supply zone and broken upwards, right? So that is called the manipulation that we have seen. And after we get that manipulation, now we on our own mind, now we now say, okay, fine, it seems market wants to reverse up, market wants to start going up. Now we are putting in consideration that this thing is happening inside our discount zone, right? Inside this zone, that's where this manipulation is happening. Once that manipulation happens, we now have in mind that, okay, yes, okay, looks like market price wants to go up, right? Now the next thing we are going to do is to either wait, depending on what we are getting at demand zone. It's either we wait for price to still give us sorry now it's there for us to wait for price to give us after the manipulation to give us another break of structure. Once we get the second break of structure, we are now positive that wants to finally go up price wants to finally go up. So now we should not take our entry from the demand zone at that manipulation level. After the manipulation, we take our entry from the demand level. And when we take our entry from that demand zone, where are we targeting? We are targeting the range high. We'll be targeting, we take our entry here, we are targeting the range high, right? We just set our order just below that low there and target the range high. So once we target the range high, we have made profit like that. Now the second thing for us to also watch out after manipulation in our discount zone, another thing to watch out for is candle formation. And what is that candle formation? It is known as the engulfing candle. What is an engulfing candle? An engulfing candle, if we have a bearish candle and we have this bullish candle here, an engulfing candle is a candle that if you are looking at it from the right side like this, look at where I'm pointing this arrow, look at where this arrow is. Let's say you are standing at this location here and you are looking at this candle at that point, you will not be seeing this other candle. You will not be seeing this other candle because this candle has covered this candle, right? Both the wick and also the body of the candle has covered this whole entire candle. So that is called engulfing. So we have the bullish engulfing and we also have the bearish engulfing, depending on where you want to take your trade. Now, example of this one, we are supposed to be looking for the bullish engulfing because market is bullish at this point. So sometimes now, after manipulation, you might just see that engulfing candle. Okay, let me use after manipulation like this, the engulfing candle might just be around that place that your demand zone is supposed to form. If you see that engulfing candle, around here, there is no need to wait for the second break of structure. Yes, there is no need to wait for the second break of structure. You can just take your entry at the body of that engulfing candle and your stop loss just below the wick, and you target it because most times, in fact, most times, price might not give the second break, might just come down and tap and then leave because there's an engulfing candle there. Engulfing candles means that price rapidly wants to go up and it does not have time to be giving other break of structures to just come down, pick your order and go up. You understand? So I will now show you examples on some of the pairs that I took, trades I took, for you to know how this thing is done. So we'll first of all look at JP, what's it called? JP, GBP, JPY. We're looking at GBP, JPY. We'll use the 2 hours time frame. There's an entry I took on this GBP, JPY last week. So yes, so this is it. So when you are looking at this price action on 2 hours, now I want to get the range of the market. I want to know the bias of the market. This is what price is doing. Price from here, price came down, price caused a break of structure, price came down, price caused a break of structure, price came down, price caused a break of structure, price came down, right? and price caused another break of structure. Now this is where I took my order. This is where I will now be explaining for you. Now once price broke that structure, once price gave us the break of structure, like I told you, we will just mark out our, sorry, we'll mark out our discount zone. And where is our discount zone? Just like I taught you, from that break of structure point to the low of that range, that is our discount zone. So the midpoint of that point is our discount level. So we'll just mark it out and we begin to wait for price to come to that zone. Right? We begin to wait for price to come to that level. Let me delete this. Alright, so now when price was coming down this way, already what we are doing is we are just waiting. So price was coming down. Now price got to our discount level. At that point where price got to the discount level, we are going to now switch to the lower time frame, right? We'll now switch to the lower time frame, and it is expected to use either 30 minutes or 15 minutes. So I will use the 30 minutes. Now when you switch to the 30 minutes, just like I taught you, when you see a manipulation, you must first of all be looking out for engulfing candle, or if you don't see the engulfing candle after the manipulation, you will now wait for another break of structure, right? So what price did here was, as price was coming down, price created a lower high, a lower low, a lower high, a lower low, then price cost a manipulation of this supply. This supply isn't supposed to hold, but it got manipulated. At that point where you just see that manipulation on the lower time frame, 30 minutes or 15 minutes, now you come to your level, this point here, and start looking for either a bearish engulfing candle, or you just look for a bearish engulfing candle. Now if you are not seeing any bearish engulfing candle, then you just have to wait for the second break of structure, right? Wait for the second break of structure. Now this is the second break of structure. After price manipulated from here, price came down a little bit and caused the second break of structure, right? After you just got that second break of structure, then your demand zone below that second break is your entry. So you just take your entry from the demand zone, and boom, here should be your target, because we are looking at the higher time frame high. Your higher time frame range should be your target, right? So but look at what happened here, because price wanted to play trick with me. Look at what happened. Let me just explain to you, because price might not give you exact thing that you're looking for, but it will give you what I just taught you, but it might not be too exact for you. It might not be too easy for you. So you have to use your head and take your entry, not just so that you will not miss any entry. So actually I was waiting for price to come back to this level, but price did not come back. Price just came down a little bit, swept this low, and started going up again, and price did not come back to this level. The price went up totally. So but as a smart trader, I just switched to my 15 minutes. I think 15 minutes or 5 minutes. So I switched to my 5 minutes, because after price took out this level, what you should be expecting again is another break of structure, because as price was coming down, as price was coming down to sweep this level, price did like this, did this low, lower high, lower low, swept that level, lower high, came down, could not sweep that level, mitigated that other block, and now swept and caused a minor break of structure. So once you see that minor break of structure at this level, look at the break of structure. Let me expand it. This is the break of structure here. Once you see that minor break, it now confirms that price might not come down to this other level again. So once you get that break of structure, your entry should be the demand zone after that break of structure. So that's why I just took my entry. From here, I took the entry. Stop loss was here. I was not targeting the range high. The range high was this high here. Here, almost 1 is to 13. 1 is to 13 risk to reward, which is a if I'm risking $1, I'll be making $13. You understand? If I'm risking $100, I'll be making $1,300. So that is it. 1 is to 13 risk. So this is how I got this order using that simple concept I just taught you. You understand? Now let's look at another one. AUD USD to finalize this thing that I taught you. Let's look at how to use the engulfing. Yes, let's look at how to use the engulfing. So we'll go to 2 hours or 3 hours or 4 hours to get our range. Okay, let's see. I think it was here. Yes, it was here. So this is what price was doing here. Let me just delete some of these things. This is what price was doing here. AUD like this, price broke, came down, broke a little bit, came down, broke a little bit. But I'm just looking for the perfect order where I would explain this thing to you. Price came down here and now went up. Okay, look at what price did. So price came down here, went up, came down, break, and now swept and caused a manipulation, right? This on the 2 hours market purged and caused a break of structure. So on our mind now, what we should be doing, because we are on a 2 hours time frame, we should just look for the range discount zone from that range. And just like I taught you, the discount zone is from here to the low that caused the break of structure. The midpoint between it is your discount zone. So the midpoint here is our discount zone. So what we should be waiting for is for price to come down to that discount zone to give us a reaction, right? So normally, look at what happened. As price broke that high, if you look closely here, you will see an engulfing candle, bullish engulfing candle. See, that candle covered that black candle, covered it entirely, meaning that candle is an engulfing candle and price really wants to buy, right? So normally what I'll just tell traders to do is to take the entry from, this is 2 hours, mind you. So I'll just tell you to take the entry from the body of the candle. You understand? But because this is 2 hours and you might have a lot of you might have a lot of what's it called, floating loss before market will now give you your profit. You market might just be dangling for a while because it is 2 hours. The time frame is too big. So we'll just go down to 30 minutes. We'll just go down to 30 minutes and still see what price action is showing. So let me just mark out the candle. Let me mark out the engulfing candle. This is our engulfing candle on on the words on the 2 hours time frame. So sometimes if you see an engulfing candle, it's just for you to take the entry at the midpoint of the engulfing candle. So the midpoint of this candle is here. If you know what you're doing, you can just take it from the midpoint and you target the high, this very high here, and that is your trade. That's your trade. Now you now be making 1:5, almost 1:6 around. Or if you go down to 30 minutes, let's go down to 30 minutes and see what happened. These are 30 minutes. If you go down to 30 minutes, you understand, you can still take the trade at this demand zone here, 30 minutes demand zone, right? Because the engulfing candle also have a demand zone there. You can just still come here, put your entry here and your stop loss here, and you are good to go. Price just came. I took this trade. It was a very sweet trade, but I targeted this entire high here because of the higher time frame key level, which I'm going to be teaching you on the next class. I'm going to be teaching you key level is just for you to know where price is going to react from the higher time frame, especially from the weekly time frame and the daily time frame. So but I'll be teaching you about key level entries. So this is just the examples of what I've taught you over here about engulfing candle and entry models. We have engulfing, bullish engulfing, we have bearish engulfing. But the idea there is that the candle must have to cover the entire, that candle will have to cover the entire zone. As in, we'll have to cover the other candle. If it's a bearish engulfing, the bearish candle must engulf totally, cover the bullish candle. If it's a bullish engulfing, the candle must engulf the bearish candle totally. So that is it for the class, and I'll see you in the next class where I'll be talking about key levels, fair value gap, and some other things. Then we'll finalize. Thank you very much.